Hi, in this video, we're going to look at 4 key ratios that are great for starting the investment research process. These 4 ratios are simple, but they tell a very powerful story when combined. The 4 ratios are price to sales, price to earnings, price to book value, and price to free cash flow. Now, fundamentally speaking, none of these are terribly difficult to calculate, but when combined, they can really tell a powerful story. Let's start with price to sales. Price to sales is a rather simple ratio. You take today's stock price and you divide it by the sales, also known as the revenue. Those two terms are used interchangeably often. And the result is something that looks like this, 2x. So in this example, if the stock price was $40 per share and the sales were $20 per share, you'd have a ratio of 2 times. Simple enough. Moving on to the next one. This one's PE ratio. This is the most common of all the ratios. We did a video on this the other day. You can click on the link to watch that one. But again, all you're doing is taking today's stock price and dividing it by earnings. Earnings is another term for profit. Now that's the fundamental difference. With this one, you're looking at the bottom line. Versus price to sales, you're looking at the top line. They call it bottom line and top line because that's simply where it appears on the income statement. Sales is the top line. Bottom line is the profit of the company. The next ratio is price to book value. This is the first one that we're leaving the income statement. Let's make that a neat arrow. We're leaving the income statement going over to the balance sheet. So here we take the price of the stock and we divide it by the book value. Book value is calculated by taking the assets and subtracting the liabilities. The theory is if you paid off all your debts and you sold all the assets, what would the company be worth? In theory, that's book value. Next ratio is price to free cash flow. This is personally one of my favorites because free cash flow, I believe, gives you a good understanding of the potential of the company. So, just like all the other ratios, we're starting with the stock price today. Free cash flow is now from the cash flow statement. So we've done the income statement, we've looked briefly at the balance sheet, and now we're on to the cash flow. To calculate free cash flow, a rough estimate of it is you take cash flow from operations, which if you ever look at a cash flow statement, that's the top section in the cash flow statement, and you subtract capital expenditures. Capital expenditures is what it costs to run the business. So for example, if you have a plant and you're making widgets, how much does it cost to maintain that plant? What if you have to repair the roof? What if you need a new machine? Things like that. That's capital expenditures. So at the end of the day, what you get is free cash flow. Free cash flow is how much money is available to perhaps pay dividends or do stock buybacks, or the company can invest in another business to help the business grow. So the question here is, what do these ratios do for us? And they all pretty much do the same thing, all looking at it from a slightly different angle. What price you're paying per dollar of, let's say, sales, in the case of price to sales ratio. So that would be, if the price to sales ratio is 2, as it was in our example, then you are paying $2 for every $1 of sales. If you're looking at the PE ratio, then that is the price you're paying per dollar of profit. Okay, so let's start with an example. This is where it gets exciting. So you can see I've pulled down the ratios for Pepsi and Coke, as well as the average of the beverage industry. The beverage industry includes companies like Pepsi and Coke, but also companies like Snapple Dr. Pepper or Monster, companies like that. It's important that we consider that because Pepsi and Coke, comparing them to just themselves, wouldn't be enough. So let's have a look. Now remember, in this scenario, lower is better. When you do a price over whatever metric, sales, earnings, book value, cash flow, the lower the ratio, the better. So, if we look at the first one, we'll see price to sales. Looks like Pepsi is better. That 2.46 means that you're paying $2.46 for every dollar of sales that Pepsi has. If you were to buy Coke, you'd be paying $5.30 for every dollar of sales that Coke has. Compare that to the industry of $3.56, which means that Coke looks like it's a bit overvalued relative to the sector, and Pepsi not only looks good compared to Coke, but also looks good compared to the industry. Let's move on and see how the story develops. If you look price at earnings, first, let's point out two different things. As you may notice, there are two different price to earnings ones here. Why is that? Price to earnings TTM stands for trailing 12 month. That looks at, in this case, right now we're shooting this, it's in the first quarter of 2018. So that trailing 12 months looks at the 2017 numbers. The PE, it should say forward PE, because that looks at projections for 2018. So if we look at price to earnings, we'll see that Pepsi once again comes in lower. But for me, this is where it gets interesting. Look at the difference between that ratio and that ratio. The price to sales, Coke has a price to sales ratio of almost double what Pepsi has. Yet they are very, very close to each other in price to earnings. That would mean that Pepsi's margins have to be significantly less than Coke's margins. So I actually went ahead and looked at that, and it turns out that Pepsi has a profit margin of about 12%. Meanwhile, Coke has a profit margin a little over 23%. So 12% to 23%. That somewhat explains what happened to the price to sales ratio. See, if you think about Coke, you wouldn't be willing to pay 5.3 times sales if the profits were only 12%. The profits for Coke are over 23%, and therefore you're willing to pay more per dollar of sales. So it starts to connect itself. So continuing on, if we move to price to book value, we see that the industry actually came in at the lowest mark at 8.6. Both Pepsi and Coke don't look terribly undervalued relative to the industry. When we look at price to free cash flow, we see that Pepsi came in significantly lower than both the industry and Coke. That, for me, is an interesting point. Now, I said before that I'm a big fan of free cash flow because this is what, in theory, the company has to work with. There's lots of possibilities. So for me, I would go back to an earlier point that we made. What happened that Coke's profit margins are so much better than Pepsi's? Is that a short-term thing? Did that happen in 2016? Is it expected to happen in 2018? I could tell you, by looking at these ratios, yeah, it looks like it's still going to happen. Otherwise, those ratios would gap a bit. But perhaps in 2019, is this a short-term thing? Because if Pepsi has much better free cash flow, that would tell me one of two things. Either one, Pepsi's going to do something, something's happening that is throwing these numbers off in the short term. Or two, perhaps something happened with Coke. Maybe something happened with Coke over this past year that threw off their free cash flow numbers. So that's something to look into. So now that we've been through these ratios, I think the next step is to go through some additional research. First, I'd want to know what happened with the margins that Coke is so much different than Pepsi. Also, what happened with the free cash flow that, again, in the opposite direction, that Pepsi is so much better than Coke. I would be digging into that, and I'd be looking further at their balance sheet. In a future video, we're going to do a walkthrough just like this, but analyzing balance sheets and balance sheet ratios. To me, what's exciting about investing is the story that develops as you get further down the research process. What is likely to happen is exactly what happened here. As you begin to map out what has happened, you're going to come up with more questions. As you answer those questions, you get more answers. Those answers lead to more questions. And you keep going down the road over and over until, to me, the most exciting part about this is when you stumble across that company that you're looking at it going, this seems to be the most obvious thing in the world. How is everybody not seeing it? So assuming you've done it right, and assuming you've answered as many questions as it takes, then there's fortunes to be made when you find that great investment. I wish you all the best, and I look forward to seeing you in the next video. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.